The result of the Greek election on 17 June means that the Victoria Centre-Right New Democracy Party formed a coalition intent on pushing through the austerity measures insisted upon by the European Union and the International Monetary Fund. But the outcome is far from clear. Chris Hart, Chief Strategist at Investment Solutions, joins us in studio to chat about the local and global investment implications after that Greek vote. Chris, thanks for your time. Yeah. I was speaking to one of our economists earlier last week, actually, and we're just in general discussing, the global economic environment and the whole Greek situation. But one comment that he made that sort of stood out for me was that, people must get away from this idea that the world is coming to an end. The world is not coming to an end. And even for the Greeks, while they are certainly under pressure, they still need to buy bread. Someone still needs to pay for something, and so economic activity will not halt.
Exactly.
But how bad a space is Greece?
Okay, at this stage, everything is unstable and it has still been deteriorating. And I liken it, I think the best is to say, in a household, if you are spending more than what you are getting in, it will be an unhappy household because you've got to try and fill that gap somehow. You've got to borrow money, you've got to scratch around, etc. And the same goes for countries. And I agree with that notion. The world is not coming to an end. I think Europe is very easy to fix. Because the moment...
Did you say very easy to fix?
Very easy to fix. The moment you stop consuming more than what you're producing. Okay? Like a household, the moment you start to take your expenditure below your income, you start to stabilize the situation, and the situation actually repairs fairly quickly as well.
But the question is, can you afford to stop spending and therefore live within your means? This is the difficulty, isn't it?
No, the point is spending is not wealth creation. You actually have to reduce your wealth consuming activities to below your wealth producing activities, which means you actually have to focus on the welfare state. That's where the problem is. And the problem is political because the politicians do not want to cut the goodies they've promised their electorate because then they get tossed out of office. Austerity is never a policy choice by politicians. It's a policy consequence. And this is what the Greeks are learning. Syriza, who said, we're going to deliver you from austerity, will actually deliver a much deeper austerity to the Greeks when they try their luck and find that nobody is prepared to help nurture them through to the next phase.
I think let's put this in context. Maybe before you come in, Mark, let's just put this in context. After the break, we're going to be broadcasting a documentary that we did on Greece that looks at the whole history of Greece, right from the beginning, through the years when there was this confusion about socialist policies versus growth policies, etc., and through also the years of the deficit spending, etc., and then the European Union, etc. So part of the question we're asking tonight is, what went wrong in Greece? In a few words for you.
Consuming more than what you're producing. In other words, dependent on outside aid, etc., and also funding that consumption with debt. All right, at the end of the day, you cut that back, you start to repair the situation.
I think it's also, it goes a little bit deeper than just spending more. I think also their productivity is shocking. I mean, they work 30 hours a week, they retire at 60, and then
challenge that. That is in the civil service. It's part of the welfare structure. Okay, in the private sector, you don't get that. Okay, you get people working decent hours, etc. This idea that the Greeks are lazy people or whatever is rubbish. We know that the Greeks here, for instance, work like dogs. Okay, in that sense. But you've got a very soft civil service. I could argue the same here. In the sense, I could argue the same in any country.
And corruption
Mark,
as well.
You obviously don't agree.
No, I don't. I think
if
I look at corruption is critical, and I think especially in the Southern European, the Club Med countries, corruption is endemic. And I think if you take a look at what you talk about GDP growth,
like
a big proportion of GDP growth is government spend. And that's kind of been the driving force, as you talk about, over the last few years.
Well, that's why they're in trouble.
And that's, and in my mind, a country that's shrinking by, call it, their GDP is going backwards at almost 6% a year, and their debt to GDP ratio is over 130, 140%. There's no way that theoretically they can get out of this. Do you know what I mean? No, austerity is not going to help, but they have to grow their way out of it. The only way to grow your way out of it is to do what Germany did. Just one second. When Germany joined up with East Germany, what they did was they kept wages constant and they increased productivity, and that's why they are in the position they are today. And that's the only way the Greeks, in my mind, and the Italians and Spanish will have of getting out of this mess, not adding more government spend to it.
Okay, we'll come to the solutions, but I just wanted to get a sense from you as well. What went wrong, do you think, in the view?
I think I've just mentioned it. I mean, I think it was, you know, number one, you had declining productivity. Yeah. Number two, you had way too much government spend and too much slack and too much borrowing. Number three, you must remember that Greece essentially lied to get into the European Union. Goldman Sachs helped them lie, so they shouldn't have been there in the first place. Number four, you know, you never had this, you know, they never put their fiscal and monetary policies. There wasn't any congruence. They didn't sort of have they didn't come together with the European Union. I mean, their debt to GDP ratio, or their budget deficit, was always above 6 or 7%. It was never at the 3% stipulated. Right. And then you look at what their strongest, you know, they look at the sectors of the economy. The biggest two driving forces in the Greek economy is now it's tourism, and essentially you have some shipping. And with the advent of Eastern Europe being up, the shipping kind of collapsed. So I think the only way, you know, there's no real industry. It's not like, you know, Italy and Spain still have real, you know, they've got engineering, they've got manufacturing. Greece doesn't really have that. And that's why I think it is seen as a periphery. France has managed to convince the world now that it's actually a core country, and you can see their borrowing rates have dropped significantly. Right. So to ask what went wrong, I think it's a multitude of factors. They just got caught, you know, in the previous discussion with Roger. He was saying, you know, what happened between 2000 and 2006 was unprecedented. You know, it was this huge liquidity. Unemployment came down, and that was the good times, and everybody borrowed. And now the party's over, rates have gone up, and that's the.
I would maintain. I agree with you to a large extent. Those are the factors. If you took away the debt, the others are not major problems. Right. The debt is the main thing. When you're funding consumption, not investment. Remember, you're funding consumption with debt. You're going to land up.
That's what they've always told us in Africa. You shouldn't be doing that. They should have been telling the Europeans as well. But there's a bigger issue here as well at play here. Yes. We are talking about a country that was able to lie its way into the European Union. So at the center of this, we're questioning the systems that the Europeans put in place, and also the advice that was given by one of the biggest banks in the world. He's just mentioned it now. I'm not going to mention it again. Well, so should we be worried about
the endemic corruption is in the financial system? Is it not? Not necessarily.
I see you did mention where you used to work.
Southern, yes, exactly. We won't mention anything like that. But you know, the point is these. You know, that's an entirely different matter. But yeah, the Greeks were not upfront. Right, but that's the political.
The Europeans should have found them out, though.
Exactly. There should have been other mechanisms to actually, you know, look at the books that that countries have. But remember, Greece was not the only one that entered the European Union not meeting the criteria. Whether it was Belgium or Italy or
Spain,
well, Spain, I think met the criteria at the time, but Belgium certainly didn't. Germany and France broke the rules, right, in the mid 2000s, just shortly after the Eurozone was happened. I always say it's not necessarily declining productivity, because in fact Greek productivity has been rising. It hasn't been falling, okay, but it's just relative to German productivity, it's been lagging, and that's opened up gaps because effectively the spending hasn't, because you've had the transfers taking place. But basically the euro is a single currency.
You're on your final word.
Yeah, they weren't. The Europeans wanted the single currency, and they wanted to keep other rigidities in the economy, like labour rigidity, and that's across the Eurozone. So there was no shock absorber. It was all rigid, and no adjustments could take place.
Mark, final word from you?
Well, I mean, you know, from my point of view, if you lie to get a home loan, for example, you know, what do you think the implications are going to be 5 or 6 years down the line? You know, and it's kind of a perfect storm in that global growth slowed, as well as, you know, the interest rates started, the expectations started ticking up, and so on and so forth. I think from my point of view, I don't think until you have integration of that fiscal and monetary policy, this problem that Greece is going through, as well as the rest of Europe, I don't see that how it's going to be able to be held together. You're kind of just creating more problems down the line. The Americans, because the Greeks cannot inflate themselves out of this debt. The Americans are basically printing currency, debasing their currency, and they're inflating themselves out. The ECB, the Germans are against it. It's just not going to happen. So as much as their currency is a store of value, I think the negative feedback loop is going to continue, and you're going to see, you know, the likes of Greece, Spain, Italy are going to sink even deeper into recession. They're not going to come out of it anytime soon.